Diaconus did not begin his life as a mathematician. In fact, as a teenager, he was doing his best to expose scammers at a Caribbean casino who were using shaved dice to better their chances against their customers. He would go on to tackle other numbers games, like how shuffling decks of cards didn't really mix up the deck. He also began to study other instances of change, questioning whether the things we think we know are in fact true, like the coin toss, perhaps maybe the stock market. So let's take a look. Most people assume the toss of a coin is always a 50-50 probability. Not so, says Diaconus, and like a good mathematician, he's proven it. I've spent years analyzing the basic images of randomness, he said. First of all, it's possible to make things random. If you flip a coin quite vigorously, it's as close to being a fair event or 50-50. However, if you think about it, you'll realize it's not random at all. The coin toss is not about probability at all, he says. It's about physics, the coin, and how the tosser is actually throwing it. The majority of times, if a coin is heads up when it's flipped, it will remain heads up when it lands. Diaconus even trained himself to flip a coin and make it come up heads 10 out of 10 times. A similar effect is seen if the coin is spun. Because of the way most coins are made, the head side can weigh more, which means it will fall on that side, leaving the tail side up more often. Further, some magicians will have coins that are shaved, giving more weight to one side or the other. The point? It's not 50-50 at all. So what does this have to do with the stock market and randomness? Well, let's take a look. According to an article by Mark Hulbert of MarketWatch, there's a 2 out of 3 chance that the stock market will rise in 2019. No doubt many of you will consider this to be good news, since it suggests the bull market will continue yet for another year. Actually, however, the odds the market will rise in any given year are always close to 2 out of 3. So there's nothing to get excited about. For starters, consider that of the 121 calendar years since the Dow Jones Industrial Average was created in 1896, it has risen in 80 of them, or 66.1% of the time. Now consider calendar years in which the stock market rose in the previous year. The odds of a rising year are virtually the same, 66.3%. And when the market fell the previous year, the odds of a positive calendar year are barely any different at 65.9%. Moreover, as you can see by this chart, the odds the market will rise are 2 out of 3 in years in which the S&P 500 PE ratio is high, as it is currently. Consider the 30 years since the late 1800s in which the ratio on January 1st was the highest, above 18.28 as it turns out. The stock market rose in 20 of those years, or exactly 2 out of 3. Another example, if a high PE were to reliably lead to subpar returns, then investors during a high PE period wouldn't wait until January to start selling. By the time January came around, the market would already have fallen enough so that its odds of rising over the subsequent 12 months have become more or less the same as in any other year. This discussion in turn points to the fundamental relationship between risk and reward in the stock market. In order to entice investors to incur the risks of losing money in a given 12-month period, the market rises in 2 out of 3 years. To put that another way, the market's equilibrium price appears to be that for which the odds of the market rising over the subsequent 12 months is 2 out of 3. The bottom line, the stock market a year from now is twice as likely to have a 12-month gain than a loss. There's no market timing magic in that. So for today, That's ChewDog Charts. Thank you.